Hi guys. Today we will analyze Signet Jewelers stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been a bad performer in the overall market. The short-term trend is negative, while the long-term trend is still neutral. Not much exciting going on here. Strong support level is around $51. Next strong support level is around $32. Strong resistance levels are around $72 and $83. Next strong resistance level is around $99. In the last month the stock has been trading between $54.50 and $72.30 range, which is wide. It is currently trading near the lows of this range. The stock has an average volume of 0.7 million. This is not a very liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 7% per year, for last 5 years. We see that the average profit margin of the stock has been around 1% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 249% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Signet Company: bad, average, and good. First scenario. Signet will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 2%. Future profit margin would be a low, 2%. Future free cash flow to net income rate would be a low, 100%. In this case, the fair value of the stock today would be $39. Second scenario. Signet will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 3%. Future profit margin would be average, 3%. Future free cash flow to net income rate would be average, 110%. In this case, the fair value of the stock today would be $53. Third scenario. Signet will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 4%. Future profit margin would be high, 4%. Future free cash flow to net income rate would be high, 120%. In this case, the fair value of the stock today would be $70. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 8.1. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Signet, analysts forecast growth rate around 4% per year in next 5 years, and future P/E around 5. Again, I will use 3 different scenarios for Signet Company: bad, average, and good. First scenario. Signet will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 2%. Future P/E would be a low, 5. In this case, the fair value of the stock today would be $21. Second scenario. Signet will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 3%. Future P/E would be average, 6.5. In this case, the fair value of the stock today would be $29. Third scenario. Signet will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 4%. Future PE would be high, 8. In this case, the fair value of the stock today would be $39. As you can see, today the stock is overvalued, $55, even if we expect the company's high performance in future. The company has a medium financial health rating, its profitability is only medium as well. Also, the stock is expected to show a small growth in revenue in the next 5 years, 4% yearly. You may like the stock at these levels. Do your due diligence on this stock. However, I'm not very familiar with the jewelry industry, so I would use an extra margin of safety. I may consider buying the stock, if the stock drops to $40. Company's strengths. Signet Jewelers is the world's largest retailer of diamond jewelry. The company is domiciled in Bermuda, and headquartered in Akron, Ohio. The company has number 1 positions in the US, Canada, and UK specialty jewelry markets. Given its size and scale, Signet is more likely to gain exclusive deals with branded suppliers, which helps to differentiate its merchandise, and enables it to avoid discounting. Signet is also one of a very few independent jewelers that can afford to market on national television. The company is focusing on expanding leading banners, improving digital infrastructure, and accelerating services to drive growth. Over the last 6 years, Signet more than tripled its e-commerce penetration, increasing from about 5% to 19%. Signet's return on assets of 9%, return on equity of 29% and profit margin of 7% are in line with the rest of the industry. Risks. Signet is highly exposed to malls and uncertainties regarding weddings given the macro environment, as inflation surges and consumer sentiment drops. The recent weakness in discretionary spending trends. Analysts see a steep drop in sales of lower jewelry price tiers, primarily price points below $500, but also below $1,000. Competitive pressures from smaller specialty jewelry stores, non-specialty retailers, and pure-play digital retailers. Signet's financial profile is highly seasonal, with the company generating typically between 35% and 40% of sales in the fourth quarter. Signet generates around half of its sales in the engagement category. Although this part of the business protects the company from fashion risk, marriage rates have seen a long-term decline in most developed markets. Of the company's cost of goods sold, 45% comprises diamonds, and 14% is the cost of gold. This exposes the company to volatility in these commodity prices, which could be difficult to pass across to consumers, who are relatively price-sensitive, given the firm's mid-market positioning. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 4% on average per year. The earnings per share is expected to grow by 2 to 4% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.